Good morning, everybody. Lewis, Andrew, thanks for joining us today. Another week, another webinar. How are you, gents? You good?
Very well, thank you.
Good stuff. Good. So as always, we allow sort of 30 seconds, 60 seconds to let everybody get themselves in and get themselves sorted. I can see plenty of people already entering the room. Lewis, another webinar, another cafe, but there is a good reason for this one, right? You're on. Are you halfway? Are you in Hull? You're on your way up to Newcastle?
York. That's it.
In York, yeah, you're in York and you're on your way up to Newcastle. You've got some corporate basketball challenge that you've been not roped into.
Yes.
I was doing a basketball thing. I think I would ring you first as well, to be honest with you.
Yeah, so it's a corporate 3-on-3 tournament up in Newcastle. And yeah, one of our clients says they kindly invite us to play in. So yeah, it should be a really good afternoon. So yeah, apologies for the cafe background and also the lack of dress as well today.
No, that's absolutely fine. I'm sure you can.
Next time we'll do it from the arena instead.
Mate, live from 7 o'clock. That would be amazing, won't it?
Yeah, that'd be really good.
Yeah, fantastic. So we've got quite a few people in already. You can all see my screen all right. Everything's visible. We're live. We're good to go. Smashing. So I want to give you guys the most time here because I know it's quite an interactive. There's going to be a few questions that I'm sure people are going to ask when they see your content today. So I'll kick things off. As always, there's just two things today. Our session will probably run for the full hour as well. And we like a lot of questions. So if you have any questions at any particular time, if there's a particular piece of content that you're seeing, or if you'd like to know more about anything, please do ask away. We welcome as many questions as possible. As always, our webinars are now CPD accredited as well. So at the end of the session, do keep an eye out for an email where you can get your certificate for today's session. So with that being said, let's get started. So I'm Lee. Welcome to the Financial Planning Club. I'm one of the co-founders and we provide one-to-one support for financial planning firms. We have got so much going on at the moment. We're helping firms grow. We're looking at the restructure and the organization of those firms. We're helping businesses scale, get leaner, and that is for the business as a whole, that's for the team, and that is for the individuals within that organization as well. Running a business, as we know, can be a very lonely place for some and challenging at times if you haven't got the right support around you. So we are firm believers of doing things, or firm believers of not doing things alone and doing things together. The other part of our business is the community. Because anyone's got side noise, or is that just me? No, that's fine. The other part of the club is the community. There is a place for everybody in our community with tons of resources available for everyone. From our CPD accredited webinars to hearing about the highs and the lows of running a business on our podcast. When we look at the WhatsApp groups, this is absolutely huge for us at the minute. It's buzzing every single day. So we've got bespoke WhatsApp groups, depending on the job role that you play within your organizations. It's a place to virtually meet and hang out with your peers. And it is real-time support. So if you've got a particular case, are you coming up against a particular challenge, whatever that may be, the WhatsApp communities are absolutely perfect for hearing about other people's the way they've navigated various challenges, if you like. So at the end of the session, there will be a feedback form. Please do hang around for 2 minutes to complete that feedback form. I know you've all got busy lives and you want to get on, but the feedback will not only help us with today's session, but it'll also invite you to come and join one of the WhatsApp communities as well. So please do hang around, get involved, and the communities are completely free as well. If we move forward, if we look at next week, we are with the incredible Justine, COO from Tatton Investment Management, and we are looking at the practical insights into personal and business branding and how you articulate that and how branding can support better client relationships. So we're really looking forward to that one. And if we look further ahead, we are with Saturn, who many of you may know, might be looking at or maybe working with, and we are aligning AI with consumer duty and business strategy as well. So some really, really good webinars that we've got coming up for you all. As always, CPD accreditation as well. Register as you usually do on our website. So hopefully we get to see some of you again next week and over the coming weeks. Just want to do a big shout out now to everybody that is now collaborating with the club, from MPS solutions to GDPR and platforms, tech, AI, all the way to recruitment. We have got some amazing firms now collaborating with the club. It bolsters the support available to club members that are going through or currently looking for a change within their business, and also a massive influence on the community with newsletters and articles and what they're up to as well. So just another big shout out to all of those that are collaborating with the club. Now I have the pleasure of handing you all over to Andrew and Lewis, who have an excellent MPS solution, by the way, which is innovative, put your teeth in, modern, with an advisor and client focus. So guys, welcome. I think it's what, the third time round, different content, third webinar, and very much looking forward to it.
Cheers, Lee.
That's all right, no worries. What I'll
Great.
do, I'll stop sharing my screen and then you can share yours. Yeah.
That's good.
Away you go.
Right, morning all. So thanks for joining us this morning. Yes, and as Lee mentioned, my name is Lewis Brasseaux. I'm Head of Strategic Partnerships for Aspen, joined today by Andrew Spence, who's CEO and founder of the business. Obviously, appreciate the lack of signal at the moment and a bit of background noise. So Andrew's going to be doing the vast majority of today's speaking, as well as the a bit quick demo actually later on the tool that we've got. But obviously, very topical point of conversation at the moment is what are people doing for their centralized retirement propositions, and how can you build this to be scalable whilst actually personalizing that to meet the different client needs of the variety of different investors that you look after. So a quick introduction as to what we'll cover today.
Yes. Can I just, is my screen sharing okay?
Yeah, screen sharing fine.
Great.
So what we're going to cover today for you is we're going to give you a very quick introduction to the Aspen business for those of you that haven't heard about us before. We're going to give you a quick introduction to some of the portfolios which tie into the CRP conversation we're going to be having, and that will be a key part of everyone's due diligence, making sure you've got ample solutions available for you to service the different segments. But then we're going to really focus today on the central retirement proposition and actually look at things like the FCA Retirement Income Review, what they're looking for from advisors at the moment. Appreciate obviously there's been numerous things being posted over the last few months. Then we're going to take a quick look at the bucketing approach, which is probably most commonly used centralized retirement proposition that we're coming across financial plans using at the moment. And as part of that, quick introduction to the 4 seasons, and then we're going to do a live case study at the end. But we do want to make this as interactive as possible. We won't take up the full hour either, so please feel free to ask us as many questions as you want. Obviously, got a chat box there as well. It's nice to see some friendly faces that joined us today as well, and some new ones. So yeah, any questions, please feel free to ask us throughout. More than happy to go through that. Andrew, do you want to start off by giving a quick introduction to the business?
Sure. Yeah, morning everyone. Thanks for a bit of time on this Friday morning. Yeah, I just want to reiterate the importance of questions. It just makes the whole experience better for all. So please ask along the way. We've got plenty time. So if we spoke just us, we'd probably be half an hour, 40 minutes. So there's plenty time for questions in between. Just a bit of an introduction to myself. So I started the Aspen business 5 or 6 years ago. I've been in the wealth management industry for about 18 years now. Started at big firm in Edinburgh, and then Williams de Brough, and then moved to London and became head of fund research at Williams de Brough in London for a couple of years, and then moved to the West End of London and joined a small firm to set up the MPS solution there, which ran with someone else for 6 years till 2018, and then felt there was a lot of MPS solutions in the market, and quite a lot of products and services doing very much similar things. So felt there was an opportunity to evolve the MPS landscape, and so started the Aspen business in 2019 or so, just before the pandemic, which is a distant memory now. So yeah, a little bit about Aspen and what is our edge in the market for those that aren't aware. So we offer probably the most comprehensive range of portfolios on the market, and by that I don't mean an endless risk spectrum of portfolios. Really a great toolkit across risk and style, and then our satellite portfolios. We're trying to move the industry a little bit more towards goal-based investing and a little bit away from simply risk profiled based investing. My view was that, and speaking to financial planners in the last couple of years, is that sending a client a risk profile, 20 questions, and coming back as a 3, and then going into model portfolio 3 isn't really a great experience for yourself or the client. So really moving a bit more towards time-based approach to investing and towards the goals of the client as well. So it allows you to create a few goals for a client and match the portfolio to that goal. And the way we help with that, and we'll give a little bit of a demo at the end, is through our technology solution. I'm a bit of a technophobe myself, so in creating technology within the business, we wanted to be super simple and intuitive to use and run. So it's fully branded in your firm if you'd like that, and that provides a really nice experience with the whole thing. Probably the most important one on here is service. I am such a strong believer in providing really good service that's relevant and useful, and not selling to people all the time. And so people that work with us can really see us as a partner to their business on the investment side for anything that they need on that front. So that could be anything from client queries when perhaps things are a bit rocky in markets, to portfolio comparisons, to opining on central investment propositions and how perhaps we might complement another solution. We have a lot of experience in the multi-asset side of things. We've seen the good, the bad, and the ugly of fund management, and so we're really hopefully a useful resource to support you on anything on the investment side.
Just on the service as well, I think this is one of the most crucial parts of when you're doing your proposition building for your retirement segment in particular. Consider this as well: platforms, back offices, etc. Whatever you're using, everything that's sort of involved in the retirement journey, because service is going to be most crucial here. This is when typically client needs are going to change, people are going to start drawing an income. So service at this particular junction for clients is massively important and cannot be stressed enough.
Can you just go on mute when you're not? I think there's been a few thanks to this. And then finally is the ability to be nimble. I think this is an important one as well. As a relatively smaller firm compared to some of the long-standing players in the market, we have the ability to get stuff done pretty quickly, and whether that's investment decision making or getting solutions into the market properly, or adapting your tech and getting feedback in quickly, it's really helpful for us. A couple of examples on the investment side. Rates in 2021 were 0%, and then quite quickly within a year we're up at 5%. Suddenly cash solutions were obviously something you'd want to consider as part of the toolkits, and so we launched our Cash Plus portfolio within a few months of rates getting to 4 or 5%. And then a really interesting solution particularly for higher rate taxpayers was the gilts portfolio that we launched a couple of years ago, buying short dated low coupon gilts, where you'd get that 4.5% or so that was largely tax free from holding that. And some of the bigger providers have sort of launched that this year, a couple of years after the event. So it's quite nice for us to be able to get solutions out quite quickly into the market. So that's a little bit about Aspen, and hopefully some differentiation here relative to the industry. That's just a little bit of structure in the business. We do focus mostly on the investment side, and that's really where you get a lot of your support that comes from there. Lewis, just if you just want to update on the people that we work with across networks, risk profiling, research systems, and strategic partners.
Yeah, so we've actually expanded this quite significantly over the last 18 months. There's actually 2 further slides already out of date. It seems to be going out of date every single week. At the moment, as more networks we seem to partner with, and obviously things like risk profiling, research systems as well come as part of that. So we are on a variety of different risk profiling. We'll do another session maybe on that another day, where Andrew probably wants to, could probably has enough to talk about for an hour there at least. But yeah, we do provide our own risk profiling as well, which is free of charge as part of that. But yeah, we do integrate all the other risk profilers as well. And yeah, over the last 18 months, we've really built our strategic partnerships and working with great firms like the Financial Planning Club, the Foundation as a key part of that as well.
Yes, risk profiling, that's a conversation for another day. So I'm not going to spend too much on so investment philosophy. This is really a retirement focused solution, but I'll just very briefly touch on investment philosophy. When you're starting a business, it's great to have a blank canvas to create something. You know, for a new financial planning firm or evolving financial planning firm, you know, really taking things back to first principles and back to basics. So 6 years ago, I had the benefit of having a blank canvas to create an investment solution. So the investment philosophy for us really brings everything together of 15 years of experience of, as I said, the good and the bad and the ugly. I've been through endless fund meetings, asset allocation meetings, big firm, small firm, to create, you know, a really simple and cohesive solution. So the importance of a long-term strategic asset allocation, I would always look for that in an investment solution that you use. You know, I think anyone that just sort of moves you know, asset allocation around without any kind of anchor, I kind of struggle with a little bit. You really need that guiding light from a portfolio construction point of view. We do believe in the benefits of making some you know, changes off that when you know, there's strong evidence or data to do so. I don't believe in market timing or sort of what I call moving the deck chairs around by kind of tweaking things here and there for the sake of pretending to be doing something. You know, moving off that strategic asset allocation is really when something structurally has changed. So, for example, fixed income, a massive change in the last 5 years of the fixed income landscape. In 2021, you just simply didn't want to be holding duration in your bond component. You know, with a Vanguard Life strategy, for example, 20, perfectly good Vanguard Life strategy, by the way. I think they're, you know, it's a sensible solution. But in their 20 portfolio, you know, you had 7-year duration bonds when interest rates were 0. Your upside there was your upside was about 3%, your downside was about 24%. Clearly not a risk reward structure you want to be taking. So having short dated there was sensible. Fast forward to today though, and bond yields are around 4 or 5%. You know, having a bit of duration in there, you know, is a perfectly reasonable thing to have now. The risk reward is much more evenly balanced. On the equity side, you know, the structure of an SAA, if you're market cap weighted, now has a lot of US exposure. That's a lot of dollar exposure. Then the dollar is devalued by around 7 or 8% against sterling this year. That's a kind of stealth, you know, fall in value of UK-based investors' portfolios. It's obviously an expensive market. It's quite a concentrated market. There's political, you know, issues that come with just going into one country. So, you know, for us, reining that into around 38, 39%. And that's a 5 to 7 year view, is just, you know, trying to give people the best chance of getting that 9 to 10% equity return per annum. So just, you know, if anyone's doing TA or asking, you know, DFMs about, you know, how they move off an SAA, I just, you know, speak to them about, you know, the structure and the process around how they make those decisions, because you really want to avoid those people that are opining when they think a recession's coming in 6 months' time, think industrial production's picking up in Europe, so overweight in Europe. These sorts of things is what I call market timing, and, you know, typically not a sensible approach for the long term. We largely believe in low-cost building blocks for the portfolio. So after you've done that asset allocation work, you know, keeping the costs down and portfolio sensible. Been to a couple of dimensional conferences over the years, managed to escape without being completely indoctrinated by the whole thing, albeit there's plenty sensible things that dimensional come out with. So we do tilt half of our equity allocation to the value, profitability and size factors, which I think provide really useful diversification in the portfolio. Whether or not these factors continue to deliver outsized returns over the long term, I guess time will tell, but you can be confident that it does provide that diversification benefit against a pure market cap weighted approach. And then finally, we do use very selective use of active funds where we think there's strong evidence of value. So smaller companies, emerging markets, and certain areas of fixed income is where there's good evidence that value can be brought from using an active fund. So these are the 5 hallmarks that we have in place in terms of our investment philosophy, and they've been great tools to use over the last 5 years when we've seen quite a few different environments. So that's just a little bit about our investment philosophy, and also just what you might want to look for when you're challenging you know, DFMs on their investment process and things. Briefly on the portfolios, so we've got 5 main risk categories and 5 styles of portfolios. That makes up 25 main portfolios. And then alongside that, we have our satellite portfolios, quite unique to Aspen. So cash plus and gilts that I mentioned. 4 Seasons is really a flagship strategy for us in that low to medium risk camp. And then at the higher risk side of things, if people want a bit of spice in their portfolio, we've got global megatrends and smaller companies. So it's this toolkit that really helps with that goal-based investing. And we'll see as we come into the retirement space, using the building blocks of models to create, you know, a bucketing approach to retirement. And it can be Aspen portfolios or others, but we're going to kind of go into that bucketing approach in a minute. Performance, I won't labor on this, but you know, protecting capital well on the downside, participating well on the upside is kind of the main objective of running money. Trying to avoid any big headaches for you is what we're trying to do. If we can sleep well at night, you can, and therefore clients can. So that is that. Protecting on this. So yeah, the US equity piece is something that's spoken quite a lot about, you know, in the last year or so, and you know, this year. I don't know whether US equities are going to fare well or poorly this year, but I did know there was a structural issue with market cap weighted, that you are putting a lot of weight on the US equity market. And obviously earlier this year, we did see a bit of a downdraft. And so, you know, being a little bit more diversified and broad-based within global equities meant we drew down about half that of a market cap weighted portfolio in that environment. Right, coming on to the main stuff of central investment proposition, but then focusing in on a CRP. So we've looked a lot in the last couple of years in terms of client segments for financial planning businesses, and we've typically put clients into 3 buckets. Client segment 1 is the accumulators, or those with relatively simple needs. Client segment 2 are more high net worth individuals, or those with more complex needs. And then client segment 3 is those in retirement, so you need a central retirement solution for them. We do on the right hand side then have Aspen solutions that fit with that. So, you know, whether it's Aspen or other solutions, generally if you're in client segment 1, I would always advise probably, you know, a relatively low cost passive style solution is probably quite suited for that particular environment, particularly young accumulators that have got a lot of time on their hands. That works pretty well with that. Client segment 2, ultra high net worth, or those with more complex needs, you might need a little bit more going on in the portfolio, whether it's you know, structuring different goals, or there's just you know, the client wishes to have a little bit more kind of going on there. And then the central retirement solution is really quite a different beast to your main CIP. And obviously there's been quite a lot of regulatory evolution in terms of needing to document your CRP. But also it just makes sense that when someone is decumulating relative to accumulating, then the investment structure could be, you know, should probably be a little bit different. So we're going to spend a little bit of time now on that third component, the central retirement solution. Lewis, do you want to give a bit of background on this?
Yeah, I was just going to sort of mention that as well. And this is where it's worth speaking on lights off. Obviously, being the guys at Financial Planning Club from the business consultancy point of view, there's amazing people like Vert out there as well who can help out sort of the processes around your CRP. Because there's 2 elements. There's actually the proposition itself. There's also the processes around your CRP in particular are really important. When the FCA launched the retirement income review, the main reason they looked at that was because of obviously pension freedoms, and you had historically low interest rates, which meant people weren't using annuities as much now for their retirement income, which now led to this huge wave of wealth to be invested. And obviously, as a result of that, there was increased risk when it comes to people's income requirements. So what they wanted to see was, have you actually documented something? Have you got processes in place that actually caters for those in retirement? And actually, have you gone through any steps in particular? And this is when it comes into the solutions that Andrew's going to talk about in a moment. Has your centralised retirement proposition helped avoid sequencing risk? That was a big concern. That's probably the #1 concern for them when it came to CRPs in particular and people running out of money. 2, were people in solutions they maybe didn't understand? And obviously, there's a greater need in retirement to look at maybe some smooth funds, etc., some different vehicles like that. But there is looking at, do clients actually understand what's under the bonnet? But it's really important for clients to have that financial peace of mind, actually understand what they're invested in and why. And lastly, and this has been a big problem with the likes of some well-known retirement income providers out in the marketplace at the moment, because they're catering to that market and it's a bit of a niche, there's probably a high cost for that as well. So our clients being invested in solutions that may be more expensive than they need to be invested in, So number one, it's about documenting that you have some form of different process and proposition around your CRP. But then let's look at those next three things, which Andrew's going to go through in a bit more detail. But yeah, if anyone has any questions around any of that, feel free to ask us throughout, and we'll happily cover that in a bit more detail as well.
So, first, look at kind of what goals people have in retirement. So there's obviously the lump sum element. So the tax-free component, perhaps gifting to children, perhaps paying down debt. These are final mortgage payments or something like that. So these are sometimes the uses of that lump sum payment. The ongoing one is then clearly the income needs. So these are day-to-day living expenses. And then, as things evolve through retirement and perhaps health deteriorates, the expenditure can increase. Also, we have inflation to consider as well. And so, the varying needs in retirement are something that need to be considered too when you're creating the investment solution. Then there's legacy planning. Do we leave a pot for children or charitable beneficiaries, or however one wishes to leave their wealth and legacy kind of going forward? Obviously, there's been some changes to that in the last 12 months with the government. And then the other important part, as we're all living a bit longer these days, is ensuring the longevity of the pot that people have. And so that it's invested not just for those that shorter term income needs, but also has the ability to grow with inflation over the long term. Because retirement, can clearly be anything from 10 to 30 years these days. So there's still plenty of time there for people to accumulate as well as decumulate. So it's how you kind of balance those two elements of the needs of someone in retirement. So just touching on sequencing risk, I'm sure everyone's fairly familiar with this now in terms of what sequencing risk is. I know there are some schools of thought out there that it's not really a thing and stuff, but I think I think mathematically it is a thing, and I think from an anxiety point of view from the client as well, I think it's it's another important factor that if you have a drawdown in the early stages of retirement that's significant, I think that could be quite anxiety provoking for the end client. So it occurs really when market volatility and occurs early in the stage of retirement, and cash is starting to come out of the portfolio. So we'll just take a specific example. So let's say someone had 200k, averaging 5% growth, say on average from their portfolio, and needing 12k of income a year from that. So an average start is that middle line, so steady growth throughout, and that pot will last a good 30 years. The bad scenario is when you have say a 15% drop in the first year or the first couple of years, potentially like we saw in 2022, and then steady 5% growth from there. Really the pot can get diminished quite quickly if you have those tricky starts to markets. Clearly, if you have a good start, then all is probably relatively well. But you're really trying to avoid that red line from a mass point of view in terms of the pot running out, but also the anxiety of the client.
And Andrew, I think obviously you alluded to earlier there as well. I think this has been the biggest misconception at the moment. Is a lot of people think, well, actually, if I'm not invested into mainly equities, I don't have to worry about those big fluctuations. But as you mentioned earlier, 2022 is a prime example where even a defensive or cautious client still have that big drawdown, couldn't they?
Yeah, you've got to make sure the investment solution's managed sensibly, because just being in bonds doesn't necessarily do it. So that lower risk end needs to be properly managed as a lower risk strategy. So we did a poll a month or two ago on LinkedIn, just to kind of get a sense from financial planners where people were at the moment in terms of preferred retirement income solutions and approaches. So the four options were cash and equity, something else, draw from a balanced portfolio, or the bucketing approach. So clearly over 50% preferred the bucketing approach as the most popular at the moment. followed by a balanced portfolio. So 80% take up those two options. Something else, there'll be elements of annuities and other sort of slightly different ways of doing things. As Lewis said, maybe a proof fund type solution, a smooth fund would be in there. And then there's been a bit of growing popularity around cash and equities. The mass is kind of there as to just being invested in equities. And actually, if you look back at data over the last 50 years, people have tended to be okay. I personally am not a fan of this. I think the anxiety that could come with this. Imagine someone in retirement going through the 2010s with a largely equity portfolio. I think that would be a real struggle for them. So I'm not typically a fan of that approach. But so our preference, having looked at the data and understanding clients' mentality and the financial planning process, is probably the bucketing approach as being a kind of sensible option.
Just on that, Andrew, as well, on the cash and equities piece, because I think you just mentioned it there really well, actually. See, people refer to that sort of like 50-year time horizon. Obviously, the conversations we're having, I think there's something you've alluded to as well. Clients in retirement typically don't have 50 years to weather the storm for markets. And actually, sometimes they need to be accessing cash in the next 2, 5, 7 years. Actually, for a lot of people, retirement might only be over 15 years. Is that a big concern you feel, especially with that?
Yeah, no, I think it's a very fair point. It's all very well looking at 100 years worth of data and seeing the equities compound 10% per annum, but you can go through an ice age of 10 years, 12 years, 15 years from equities, and every one asset class, whether it's commodities, fixed income, or equities, can go through long periods of underperformance and outperformance. We've gone through a period where equities have been particularly good, commodities have not been great, fixed income has not been great. There is no reason to think that doesn't flip around, going forward. So, I think someone in retirement should be pretty well diversified across asset classes. So yeah, when it comes to then, your CRP, so it's just kind of taking a step back again, first principles approach. What are the key hallmarks you want in a CRP solution? So I think it needs to be simple for clients to understand and for you as advisors, financial planners, to be able to explain. I think it needs to be versatile. I think it's one of the most important points, to allow for changing circumstances in retirement. It needs to be reliable. You need to have full confidence in it. And it needs to be repeatable across your client base or across the business if there's multiple advisors within the business. You don't really want, well, we'll do a bit of that for that client or that advisor or a bit of that for that. You want something that really can cater for everyone in retirement. So I think for us, those are the 4 hallmarks we would think is sensible for CRP. So that's why we feel the bucketing approach works pretty well. So the bucketing approach for us is a 3 elements approach. It's really kind of a short, medium, and long-term pot approach. So the short-term pot we call liquidity, which is your immediate cash needs and really helping to avoid that sequencing risk side of things. So that's typically 12 to 24 months of cash. And any market downturn historically has typically not been much longer than 2 years. So that really kind of helps with that component. The next stage is what we call the lifestyle stage. So that's that medium term pot. So that's probably 2 to 7 years. So that's aligning the strategy with the current or desired way of living going forwards. And then the third pot is the longevity pot. So that's the sustainability of the pot over the long term. And this is 7+ years. And so you've got time on your hands with this pot. And so putting portfolios then into that, so we'll give an example of the Aspen portfolios, but clearly there's other portfolios on the market. But liquidity, you can consider the Aspen Cash Plus portfolio, or Platform Cash if it yields quite well is suitable there. Lifestyle, so that medium term pot, people have often struggled a little bit with how to manage and handle and what products to use in this pot. We've seen some absolute return funds such as GARS come and go from this area. Proof fund is sometimes used in this area, but they're quite opaque and have their complexities and sometimes cannot be reliable in those pots. So there has been a bit of a challenge in terms of how to handle that medium term pot. And then the long-term pot is probably a little bit easier. There's lots of solutions here. We would probably suggest, so for example, here our growth passive solution, something probably in the 70-80% equity component. You've got time on your hands here, so that works quite well. So if someone has a 20-year time horizon in retirement, we would typically suggest a blending as appropriate around the sort of 2 years, 5 years, and 13 years for these three elements. And typically, in terms of risk profile, a lot of people kind of land on that medium risk side of things. And by structuring this in such a way, what you're doing is you're lowering risk a bit at the front end, where time horizon is shorter, and you don't have the time to kind of recover, and you can raise risk a little bit at the long end where you have time on your hands. So you can, instead of going in a balanced portfolio at the longer end, you can actually increase that a notch, perhaps to a growth solution around 70-80% in equities there. And the client, if you frame it in this way, the client really kind of gets and understands it. They know they don't need to worry about the next 2 years. They know they don't really need to worry about the 5 years after that. So it really, kind of helps with the client anxiety around that. And then from a maths perspective, it makes a lot of sense to structure things kind of in this way. Kevin, question from you: how would you realign to the 10, 25, 65 mix? So yeah, very good question on this. I think I understand the question, but I think the question is, if after a year has passed, for example, you've drawn down half of that cash pot, what would you then do to the aggregate allocation with that? We would suggest that if nothing major has changed with the client's circumstances and the market is, maybe plus 15% or down 10%, not significant major outlying market moves, we would suggest just a rebalance to that allocation. So 1 year's worth of cash coming down from that growth pot into that medium-term pot, and then from that medium-term pot into that short-term pot. Where you might not do that is clearly if the client's circumstances have changed, if they've poorer health now, they've gone into a care home and their costs have gone up, you might want to increase pots 1 and 2 because a lot of front-end costs now for the client. Or if there's been a very significant market move, particularly on the downside, say equities have corrected 35-40%, you might say, let's just leave that longer term pot for now, and we'll just draw from that medium term pot and give that a little bit of time to recover. So those are the sort of circumstances we would see, the changing of that. But what this is a nice controlled environment to have a little bit of flexibility within that, instead of just going to a one fund decumulation strategy that doesn't quite have that flexibility for those changing kind of environments. Hopefully that answers the question. The next step is just touching on Four Seasons, but is there any other questions around like the structuring of bucketing, or I don't know, Lewis, if there's anything you want to raise in that capacity? Otherwise, I'll just crack on with just 5 minutes on Four Seasons, because it's a little bit different way of framing that medium risk pot.
Yeah, quick one second. See if that'll work. I just had a message back. The feedback might be coming from your end of your nice speak, so I'm going to try that, and then I'll mute myself. I'll mute you in a minute. Yeah, so on the middle bucket, I think this is the bit that people are struggling with the most, because it's 2 years is great, but for a lot of time, see if anyone's obviously done their exams recently, or obviously looking back for the textbooks, etc., wherever it may be, we're all inclined to look at, when you look at time horizons for investing, typically equity should be focused on 7+ years. So it's what do you do between that 2 and 5 year space in particular? I think that's the bit that people are struggling with the most, and there's lots of good solutions out there. Now, also on the bucketing approach, even though you are looking at this from a CRP point of view, you can look at this for those even approaching decumulation, not necessarily straight into decumulation itself. You might decide, actually, I'm not going to have a cash bucket, but I'm going to have something like a Four Seasons portfolio, that lifestyle bucket, with maybe that longevity pot, and I'm going to start increasing that as I come closer and closer to retirement. So it's definitely one to consider. Yeah, I'll let Andrew go into Four
Seasons. This is a question from Robert on in terms of then the structuring of the tax wrappers in the bucketing approach, and then this is just another layer of complexity to the whole thing. It sort of depends on what works best. Clearly, ISA and pensions are tax wrapped, and so there's the flexibility there in terms of income and other bits and pieces. If there's quite a big chunk in, say, general investment accounts, you could be a little bit clever with that and maybe have an amount of that in the gilts in a gilt solution or something as well in that short-term pot, because that's largely kind of tax-free. Lewis, I don't know if you have any comments in terms of how you'd structure that on the kind of wrapper side of things.
Yes, it's a really good question, to be honest. And what we're seeing from a lot of people, it's usually platform dependent in how you want to do this as well. Most good platforms will allow you to look at things like that holistic view and look at all the wrappers together. And a lot of them have got really good income withdrawal tools, etc., which will help you look at what pots may be best to deplete first. And all you want in the back end, and this is something that we've built to help people out with that, is some form of tool that you can utilize that aligns with those tax wrappers, and you can then look at, well, which buckets do we want to split into each? Because actually, and also we've seen this most recently with the pension changes as well. People weren't necessarily taking pension income straight away because it was a really good IHT saver there. However, things have changed somewhat now as people are looking at starting to take more income from ISAs, GIAs, etc. Later, and maybe doing some of the pensions first. So things have completely changed in that regard. But yeah, you want a good process and you want good tools that will help you look at that diversification between the tax wrappers in particular and how you look at each one. But yeah, I'd recommend looking at most platforms, to be honest, because you have really good income withdrawal. I think Aberdeen's almost called it the income withdrawal optimizer tool, and there's loads of others out there as well. It's a really good question.
Right, just touching on Four Seasons for 5 minutes, because it's just a little bit different from a conventional portfolio. So this is kind of a flagship strategy from us at Aspen. We have a portfolio and a fund version of this. So really it seeks to preserve and grow the real value of capital by balancing growth and inflation factors. These are your primary movers of asset prices. By using a tried and tested blend of bonds, equities, and commodities. So nothing funky here, no shorting, no market timing, no use of derivatives, to deliver that relatively smooth return profile over time. So typical investors in the Four Seasons portfolio, those seeking to preserve money against inflation, those approaching retirement, perhaps in that lifestyle phase, as it's often called, those in pension drawdown, so in that medium term pots are really suitable for that. Those seeking a home for excess cash, or those that just generally have a relatively low attitude towards risk. It's really useful in that capacity as well. So just understanding, and this is just a really interesting way to kind of consider how markets move and what affects them. So any market environment that we find ourselves in can reasonably be put in one of 4 camps. And this is not us that necessarily just completely created this and made this up. Work from Bridgewater, Ray Dalio, work from David Swenson, ran the Yale Endowment, sensible people that have put this structure and believe in this kind of style and way of creating a truly balanced portfolio. So as I say, any environment we find ourselves in can be put in one of 4 camps. Either growth is going above trend or below trend, or inflation is going above trend or below trend. So spring would be that disinflationary boom. That's the mid-1980s, the 1990s, and the early 2010s, a pretty good environment. Summer is an inflationary boom, the late 60s, the late 70s, and the early part of the 2020s. Autumn is stagflation, when inflation's rising, growth is falling. So that's the 1970s and the early part of the financial crisis. And then winter's that deflationary bust, so that Great Depression in the 1930s and the financial crisis. So growth is falling dramatically below trend and inflation is lower or falling. So the early days of the COVID pandemic would be put in that camp as well, before we start to move to the top right quadrant. So what we look to do is see what assets do well in each of those 4 environments. So in that good environment, which is the good news is we spend quite a lot of time when growth is stable or moving above trends and inflation is relatively low. So corporate bonds and equities do well in that environment. When growth is rising and inflation is rising, you want value stocks, emerging market stocks, and commodities. So in 2022, holding these would have been really helpful. When inflation is rising, growth is falling, you want inflation-linked bonds and gold. So we've seen some elements of that this year. So hence why gold's been doing really well. And then when growth is falling and inflation is falling, you want various duration in sovereign bonds, cash, and if you are holding equities, mid-vol stocks do well in that environment. And so in the Four Seasons portfolio, we allocate 25% of our risk into each of those four camps to create a truly diversified and balanced portfolio that looks like this. So cash, bonds, equities, and commodities, all long-only assets that on a total return basis over time will, hopefully go up in value if history repeats itself in some capacity. But it's all the variations you kind of have within these that makes a really diversified portfolio. So the blend of short-dated to long-dated bonds, the inclusion of inflation-linked bonds, the various styles within equities, proper diversification in there, and then the use of commodities, so around 12.5% in there. So gold at around 7.5%, obviously been a great asset to hold this year, and then commodities in there at 5% as well. And today's a unfortunate day where we're seeing a rise in tensions in the Middle East, and oil prices are up 7% or so, up 10% in the last couple of days. So you never know when you're going to need commodities in the portfolio. It's not just for wars, but in the AI age that we're coming into, metals and mining is going to be in great demand as well. So people have kind of forgotten about commodities in the portfolio. Most allocations in portfolios are less than 2%, but in the Four Seasons portfolio, we have them in there at a good weighting and for good reason. And so this is then that asset mix over the last 50 years. So whatever has been thrown at it, whether it's world wars, economic booms, economic busts, inflation shocks, this asset mix has been able to weather them all. Net of fees delivering around 7%, and no 12-month period where it's recorded more than a 10% loss. So really sort of sensible asset mix, largely populated with index funds. So it's a nice low-cost solution, but it's really that worry-free portfolio that delivers that inflation beating returns, and also just that someone's money is doing something for them sensibly. And just finally, this is it this year. So global equities in the red, and the Four Seasons fund and portfolio in the green there. So not really noticing that big drawdown we saw in equities, and up around 3.5–4% this year. So just doing what we'd hope and expect. So yeah, that's Four Seasons, which I'm very happy to talk more on at another day. Just to kind of finish things off, I just wanted to bring everything together a little bit in terms of the technology that I mentioned at the start, and hopefully other providers are starting to bring good technology to market. But this is just a little view of what we provide, and this is what we call portfolio discovery. So it's available in your brand completely if you would like it. This is in the Aspen brand today, but a really simple piece of software if you just wanted to see latest fact sheets of the portfolio. Any of the portfolios, you can just click in here and see the latest updated fact sheets, which are always on hand. So that's there. I'm a big believer in everything being super simple and nicely laid out, not plastered with lots of risk profiling badges and things like that. So just sensible alignment of a portfolio fact sheet with your contact details at the bottom and things like that. So putting you guys front and center of the process. I'm just going to go into the portfolio selection process. So this kind of brings the CRP side of things all together. So let's just let's say I'm the client, for example, for the purposes of this. So you just select a client. It's very simple. You just put name and email address, not kind of blood type and dog's name and these sorts of things. So let's say we're doing retirement pot for myself that we're going through here. So I think we'll include, one of the questions that came up in terms of various tax wrappers. So let's say someone has £900,000 in a pension pot, and perhaps £100,000 in an ISA. So £1 million kind of pot available to invest here. We can add any notes around that we wish in terms of how we want to structure things. But let's say this is the investable pot, and this person in retirement needs 50k a year, for example, from their investments. Let's say they're a medium risk investor. We mapped, as Lewis said, all the various risk profiling tools, but let's say they're medium risk. There is this charting functionality to really help understand the risk and reward conversation. So what it means to be low risk relative to high risk. why you want to invest relative to holding cash, relative to inflation. We can toggle on world events to see how things kind of handled these things. Market downturns we can kind of look into and focus in on. So if you're medium risk, for example, when the financial crisis struck, what would have reasonably happened to your portfolio versus being high risk and low risk. And so you can kind of discuss risk and return in a nice way there.
Just,
So we decided on, sorry.
Just quickly on that point as well. So this is one of the things, especially things like that chart will help out with, but this is one of the things that the FCA were concerned with in particular, and they wanted to see as part of the centralised retirement proposition is, are you revisiting those conversations around risk? And have you evidenced, again, the client's capacity for loss? Because what their capacity for loss would have been during accumulation, obviously, versus decumulation will change quite substantially. So it's about having that really, and as Andrew mentioned, that more educational conversation with the client around risk versus reward. And do they still understand what it means to be in that medium risk profile, medium high risk profile, whatever it may be? But that's what the FCA are looking for. Just please just document it. Just say that you've had that conversation and have a good way of evidencing that within your process is very, very important.
So we've decided on risk, and so now we want to decide on style to kind of whittle the portfolios down. Let's say we're going to go in this case for a relatively low cost solution, so we're going to go for a passive plus option. So what the application for us is then doing is suggesting, okay, we've gone medium risk, we've gone relatively low cost solution. The balanced passive plus portfolio is the one that's probably most suitable, and that might be fine. You know, you might say, actually, I'm just going to apply that to the pension and the ISA. I'm just going to draw down cash from that. You know, as we saw in the poll earlier, still around 20-25% of people are comfortable with that, and that is still a perfectly reasonable kind of option. But if you wanted to do the bucketing approach a little bit more and create a little bit more of a bespoke solution for this client, what we could then do here is, so notice up here, we're 3 out of 5 in risk at the moment. So let's say in the ISA, let's just say, for example, say we're just going to put that into the cash. So 2 years worth of cash is going to go in there. And then with the rest of the pot, what we're going to do is we're going to add in the 4 seasons portfolio. So we're going to put 5 years worth of cash in there. So that's £250,000. And then finally, we're able to, what's happened here is, you know, the risk has obviously fallen, and we're going to add in a slightly higher risk portfolio here, the growth solution for 650,000. So now what we've done is we've created a short-term, medium-term, and long-term pot within the pension. You know, as the example, we've lowered risk at the front end, we've raised risk a little bit at the long end, and we can see that the overall risk around 3.2 out of 5, still exactly kind of where the ballpark as to where we'd want it. And so that's using the bucketing approach to build that portfolio. And then at the end of that, you can get a nice report. Again, if this is all nicely delivered in your brand, if you would like it, where you see kind of that journey that we went on, and then the portfolios that kind of come out of that. So I'll just briefly show you that report when it loads in. So yeah, the recommendation report here, prepared for the client by the advisor, the role of the advisor in the process, the role of Aspen in the process, what is an NPS, the portfolio structure that we've gone for, any notes that have been added along the way, risk profile, what does it mean to be in that risk profile, the portfolios that we've gone for, and then the fact sheets on those various portfolios in there. So nice and simple and clean structuring of that kind of output. So that is kind of the main parts of what I'm just going to stop sharing my screen. There. There's a couple of questions that have come in. Firstly, on the FE one, yes, we're available on FE. Do you offer an OIC structure or just MPS? So yeah, just on FE, all of our portfolios are available on FE. The MPS versus OIC, yeah, it's interesting to see how the world's going to evolve between these two. You know, the tax element just stayed within the threshold of NPS. I think if CGT had gone above 30, I think the move to OIC would have been greater. But I think 24%. Then, you know, NPS 20 and 24% for general investment accounts is still kind of okay. And so we offer largely NPS solutions. The OIC version of we have an OIC version of the Four Seasons fund, and that's the only OIC at the moment that we offer. But clearly, in pension wrapped assets, then model portfolios, you don't have to worry too much about the tax element. Yeah, the Four Seasons, you mentioned that there, Liz. So that's kind of everything that we were kind of going to mainly go through. There's 5 minutes left. If there's any final questions, or Lee or Lewis, do you think there's anything we've perhaps not covered that is worth touching on?
I think that's the main thing. The other thing I was going to say was obviously we'll send out everything afterwards for yourselves, including access to recording, etc., all that sort of stuff. So yeah, any questions, feel free to ask us afterwards. More than happy to jump on the call, or if you wanted to even see the tool in your branding, happy to do that as well.
Yeah, absolutely. There's a part in the feedback as well on the survey. When you exit the webinar, there'll be a part on the feedback where if you do want to hear from Aspen, you want some more details, just select the box on the feedback, and they'll make contact and set you guys up a conversation as well. So it's really good, really good. Good session, guys.
Cheers, Lee. Thanks for having us as always.
I had to shut my camera off for a minute there. I had a sneezing fit. Hay fever is rife at the moment, so
that's terrible, isn't it?
I think everybody's
on the same.
really bad hay fever at the moment, so I had to shut it off before I look like a fool on camera. But no, thank you again for joining us, and it's a pleasure. And until next time.
Yeah, look forward to it. Have a good weekend.
Have a great weekend, everyone.
Thanks, everybody. Thanks for coming.
Bye.